Okay, I apologize for the last video. This is video number 6. Video number 5, I looked up and I was just about to the limit. I tried to hurry and finish, but I didn't quite get done. So I was explaining the net effect of a stock dividend is to transfer amounts, not really transferring money, but just to transfer an amount from retained earnings into contributed capital accounts, common stock, and additional paid-in capital. We do that by declaring the dividend. We debit dividends, credit common stock distributable, and which is a liability account kind of. It's really more of a owner's equity account, but temporary, and crediting additional paid-in capital in the case of a small stock dividend. Now, then when we distribute the stock, we debit common stock distributable, closing out that account, and credit common stock. So we have increased common stock, we have possibly increased additional paid-in capital, and then we have debit to dividends. Then at the end of the year, we credit dividends to close it out and debit retained earnings. So the net effect is to reduce retained earnings and to increase common stock and possibly additional paid-in capital. So we're moving funds, not or just amounts, from retained earnings to contributed capital accounts. Now you may be wondering, why do you do that? Well, several reasons. Number one, sometimes the stockholders are crying for a distribution, for a dividend. You can give them additional shares of stock without having to part with cash, and you may need the cash to fund some sort of growth. Now, from a stockholder standpoint, you may say, well, if they want a dividend, they probably want cash. They don't want more stock. Well, if they want cash or need cash, they can sell that additional stock and raise cash. So that kind of solves both issues. Another thing is it reduces retained earnings, which quite often when investors see a large balance in retained earnings, they're saying, why don't you pay some dividends? You've got plenty of retained earnings. So management may choose to reduce retained earnings by paying a small or issuing a small stock dividend, or a large stock dividend for that matter. Now, another thing that a stock dividend can be used to do is to change the price of the stock. So this is more common with a large stock dividend than a small stock dividend. But you issue a stock dividend, did the corporation get any bigger? Well, the answer is no, they're still the same size, but there are more shares of stock out there. So therefore, it will reduce the price of the stock, because if the corporation was worth $10 billion before you issue the stock dividend, it's still worth $10 billion, but it's divided between more shares of stock. So that's common, especially with large stock dividends. If a company or a corporation issues 100% stock dividend, we would expect to see the price approximately cut in half. Now, quite often they do that before a stock issue to get the price into the range where they think investors who would be most likely to buy their stock would want to pay. So a company like Home Depot, they may say, well, we think the investors who want to buy our stock would be more from the working class and more interested in paying a price of, say, $20 to $30 per share. And let's say their stock is trading at $60 per share. They might issue a 2-for-1 stock split, a 3-for-1 stock split, or a 200% stock dividend. Now, the 200% stock dividend would say, well, for every share of stock you had, you now get 2 additional shares. So now there are 3 times as many shares outstanding, the shares that were originally outstanding, plus the double that number of shares that are issued in the dividend, the 200% dividend. Now, stock splits is the next topic down here. And stock splits and large stock dividends look very much the same. They are very similar in many respects, but we account for them differently. Now, a stock split is where we issue new shares of stock in place of the old shares. So a 100% stock dividend, you get 1 new share of stock for every share of stock you had. So if you had 100 shares, you get 100 additional shares. You now have 200 shares. But it's still the same par value as it was before. So if it was $1 par, still $1 par stock, you just now have twice as many shares as a result of the 100% stock dividend. Now, a 2-for-1 stock split would be this about the same thing and accomplish about the same thing, but again, it's accounted for differently. Now, the way a 2-for-1 stock split goes is we say, okay, we're issuing a 2-for-1 stock split. And so what that means is your old shares are no longer good, they're no longer valid, and you get 2 new shares for every 1 share you had before. So again, if you had 100 shares, you now have 200 shares. If the old shares had a $1 par, you had stock with a $100 par value. So you had 100 shares with par of $1 per share, so a total par value of $100. Under a stock split, you issue 2 new shares for every old share. The old shares are no longer any good. The new shares have a 50-cent par value. So you still have stock with $100 par value. It's just now 200 shares with a 50-cent par rather than 100 shares with a $1 par. Now, from an accounting standpoint, there's really no accounting for a stock split. There's no journal entry. We just make notes in our records to indicate number of shares people now have and what those shares par value is. But if you think about it, total common stock remains the same. So they show you this down here. So before the stock split, a 2-for-1 stock split, we had 1 million shares outstanding, 1 cent par, total par value of $10,000, total retained earnings of $650,000, total stockholders' equity of $660,000. After the stock split, we now have 2 million shares at a 0.5 cent par value, still has a total par value of $10,000. Retained earnings did not change because we don't record any dividend or anything like that, and total stockholders' equity did not change. Now notice they left out additional paid-in capital here, which you would expect to have, but it's unimportant to what they're illustrating. Okay. And choosing between a stock dividend and a stock split really is more to do with, do you want to reduce retained earnings or not? So, and they make the point here that total stockholders' equity is not affected by either one. It's just with a dividend. Oh, with a cash dividend, yes. Out here they're talking about cash dividend, then total stockholders' equity is reduced by the amount of the cash dividend. Stock dividends, it's not. Okay, we have mini exercises 11.9 and 11.10 and exercise 11.14 we want to look at now. So mini exercise 11.9, and I've lost my cursor. There it is. Determining the impact of a stock dividend. So Sturdy Stone Tools Inc. announced a 100% stock dividend. So we're accounting for a large stock dividend. It's accounted for at par value. Determine the impact, increase, decrease, or no change of this dividend on the following. Total assets, no effect. Total liabilities, no effect. Common stock is going to go up because we are going to issue additional shares. Total stockholders' equity will be unchanged. We're increasing common stock, but we're decreasing retained earnings, which is a stockholders' equity account. And market value per share, you'd expect it to go down, about cut in half. Usually it doesn't quite cut in half because the market views that as a good signal when you're issuing a large stock dividend. So there you have no change in total assets, no change in total liabilities, increase in common stock, but no change in total stockholders' equity. Retained earnings decrease is equal to the increase in common stock and a decrease in market value. Now the next one, they ask you, complete these requirements, but assume that the company announced a 2-for-1 stock split. Well, their common stock amount is not going to change. The number of shares will change. They'll double. The par value will be cut in half, but common stock will remain the same. Total stockholders' equity will be unchanged, and the market value of the stock would be almost cut in half. Usually cuts in half and then goes up a little bit as a signal that the company expects to do well in the future. So no change, no change, no change, no change, and decrease in market value. Okay, and let's do exercise 11.14. That's the last one we have assigned. So there it is. And let's go look at it here. Come down here. Keep going. And there it is. So on July 1st, Jones Corporation had the following capital structure. So we see common stock, par value $1, 8 million shares authorized, 100,000 shares outstanding, so $100,000 of par value of common stock, and additional paid-in capital $90,000, retained earnings $170,000, and no treasury stock. Complete the following table based on 2 independent cases involving stock transactions. And our time, we've got about 1.5 minutes. I'll go as far as I can. So case 1, the board of directors declared and issued a 100% stock dividend. The stock price was $8 per share. Stock price is unimportant because it's a large stock dividend. It's accounted for at par. So before the stock dividend, we had $100,000 here. After the stock dividend, we are going to have $200,000 here and only $70,000 in retained earnings. Total stockholders' equity will remain unchanged. So there you see it, 200,000 shares, $1 par, $200,000 common stock, $90,000 additional paid-in capital, and $70,000 instead of $170,000 in retained earnings. Total stockholders' equity is unchanged at $360,000. Okay, with the stock split, notice the par is cut in half. Number of shares is the same, but all of these amounts remain unchanged. So that was from a 2-for-1 stock split. Okay, my